Chapter 6: Equities, Securities, and Stock Exchanges. So we just discussed that in this course we'll be focusing on the major United States stock exchanges. However, what is a stock exchange, and how do you know if it qualifies or not? New York Stock Exchange, also commonly abbreviated as NYSE, is a stock exchange based in New York City and is considered the largest equities-based exchange in the world, based on total market capitalization of its listed securities. Wow, that's a mouthful, right? It's actually pretty simple, but the average person we know would have no idea what that definition meant. So let's break it down for practice on how we would learn what this meant. Applying the vocabulary building exercise. First, we'd read through the paragraph. Second, we'd write down a list of terms or phrases that were unfamiliar to us. I'm going to write down equities-based exchange, total market capitalization, and listed securities. Next, we'll use our friend Google search. Let's type in equities-based exchange into the search area. Let's start by defining equities-based exchange. As we discussed earlier, an equity investment generally refers to the buying and holding of shares of stock on a stock market by individuals and firms in anticipation of income from dividends and capital gains, as the value of the stock rises. So an equities-based exchange would be a place where shares of stocks are traded between individuals and firms in a marketplace fashion. Next, let's define market capitalization. Investopedia defines market capitalization as the total dollar market value of all of a company's outstanding shares. Last, let's research listed securities. Again, Investopedia defines securities as a financial instrument that represents an ownership position in a publicly traded corporation, stock, a creditor relationship with governmental body or a corporation, bond, or rights to ownership as represented by an option. Now that we understand the terms we didn't before, let's fill in the blanks with the definitions. The New York Stock Exchange, commonly abbreviated as NYSE, is a stock exchange based in New York City and is considered the largest equities-based or stock market for buying and holding shares of stock marketplace exchange in the world, based on total market capitalization or the total dollar market value of all of their company's outstanding shares of its listed securities or of the publicly traded ownership positions listed. Great, now it's easier to understand what the New York Stock Exchange really is. Nasdaq Stock Exchange, NASDAQ. The NASDAQ stock market, commonly known as the Nasdaq, is an American stock exchange. It is the second largest exchange in the US and world by market capitalization and trading volume. The Nasdaq has been known for including growing tech companies and more, but is another great option for finding great long-term growth investments. Dow Jones Industrial Average, DJIA. Dow Jones Industrial Average is a price-weighted average of 30 significant stocks traded on the New York Stock Exchange and the Nasdaq. The DJIA was invented by Charles Dow back in 1896. Equities and securities. The terms securities and equities are used frequently when discussing investments. The terms are thrown around in many different contexts as well, but the key to understanding their terms and their contexts is understanding their meanings from a fundamental standpoint. A security is a tradable financial asset of any kind. Securities are broadly categorized into debt securities. Some examples of these are banknotes and bonds. Derivative securities are more complex concepts such as forwards, futures, options, and swaps. These will not be covered in this course. Equity securities, which are common stocks. When referring to securities in this course, we'll be referring to the equity securities. Equities, or an equity, is a stock or any other security representing an ownership interest. As an example, let's say your friend Joe Schmo started a lemonade stand business, and in order for him to open his new business for sale, he required a $1,000 investment for building materials, recipe inventory, advertising flyers, and labor costs. This investment would allow him to start the business and keep the doors open for 6 months to reaccumulate the investment and then grow the business. As an investor, I'd then evaluate your friend Joe Schmo's lemonade stand business plan, and if I recognize potential for success, I'd offer to invest in his business. In this example, let's keep it simple and offer cash for equity. What this means is, as an investor, I'm offering an investment of cash in exchange for a share of the company's ownership based on its current market value. This leads us to our next question. How do investors know what a company is worth? Let's dig into this next. Basic company valuation. There are two main types of valuation: pre-money valuation, the valuation of the company prior to investment; post-money valuation, the valuation of the company following the investment. Going back to Joe Schmo's lemonade stand business, let's break down the two differences in valuation. The value of the company prior to my investment would be known as the pre-money valuation. A post-money valuation would include my investment into the value of the company. These two numbers are important in small business valuations in particular. However, on a large-scale company evaluation, this is likely not helpful. So what are you looking for stock valuations? Because it is required by law for publicly traded companies to declare all information about the company to the public, there is a lot of information that needs to be evaluated before committing to a stock investment.